Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Friday. It's April 1st. It's about 7:42 in the morning. The market's going to open up in about an hour and 40 minutes. If I've been guiding, navigating, helping you throughout this market, I want to hear from you. Send me an email, support@marketgeeks.com. It brings me a lot of pleasure to hear from you. And if I'm doing something wrong, if I'm doing something right, if you want me to do something different, let me know. It'd be great, and I'll respond back to you too. I don't bite. Anyway, happy Friday. It's April Fool. Hopefully nobody pranks you too bad. The question on everybody's mind right now is the rally that we've seen in the S&P and the Dow and the QQQ, is it going to continue, or are we going to falter and go back to the base? And we'll get into the technicals in a little bit, and I'll try to answer your question today the best that I can. Look, the truth of the matter is nobody can predict the future. We're pretty good at it, but again, we don't have a crystal ball. So the indices are pretty good. And remember, Friday and Mondays are usually pretty bearish days. So whenever we open up so high, it usually causes me to think twice about what's going on. But we'll take what we can at this point. The fact that we're still seeing this crazy volatility is telling me that the market's still in play, and that we are still in a pullback recovery mode and not a bear market. Usually bear markets, stocks become very listless, volatility declines, there's not a lot of interest. Right now we're on the brink of earnings, and if earnings are better than expected, this stock market is going to go higher and make new highs. At least that's what I believe. I'm not as bearish as a lot of people out there, but again, I may be completely wrong. So again, it's great to have multiple sources of information so that you can make your own decision under the circumstances. Anyhow, the market's starting off pretty good today. If you look at the news, jobless claims were okay. There was nothing really great about it, but there was nothing really bad about it. Personal income was right on par. Today we've got employment situation, the big report of the week following the GDP, which was also okay. All the reports this week are coming out right in the middle. They're not coming out really great. They're not coming out really bad. They're coming out right in the middle of the range so far. I don't want to jinx it, but that's not bad, especially in light of what's going on in the world right now. We've got construction spending, which I can't wait to see. This number should go up quite a bit. Can you imagine the construction spending costs we're going to be incurring when we go back to Ukraine to rebuild all the stuff that's being destroyed right now? Because you know who's going to be rebuilding it. That's why I'm bullish on basic materials. ISM Manufacturing Index is the big report. This will give us a good indication of the supply chain issues. And then we have employment situation. Just to give you an idea of what we're expecting in terms of the employment situation, there's always a low and a high. The fact that we're between 200 and 700,000 tells me, usually when the consensus is this wide, it means the analysts have absolutely no clue what to expect. Whenever it's tight, like 3.6 to 3.8, then it's meaningful. But whenever you see a number like this, 200 to 700,000, they're just throwing darts at the board. 678,000, 490,000, they're just all over the place. I would look at the unemployment rate. And if the unemployment rate is really, really low, right, then the Fed may say, well, we have to back off from raising rates. There's just not a lot of people working right now. And that may cause the bond market to rally. If the rate is really, really low, then they're going to say, hey, there's plenty of people working. The economy is picking up solid. It's okay to raise rates. Therefore, what you want to do is you want to pay attention to the bond market today. As a matter of fact, a lot of what's happening is impacting the bond market, and the bond market actually has been moving higher till today. Now it's backing away a little bit, but the stock market's higher. Anytime you see the bond market moving higher, that means interest rate sentiment is moving lower, and that's beneficial for the stock market. But again, today we're in this little zone. I really wanted to see the bond market rally up to the 50-day moving average so we could sell it. Not seeing that as of yet. Let's talk a little bit about global economy. Bank of Japan closely watched quarterly gauge of business sentiment. The Tenkan showed that the benchmark indicator for large manufacturers dropped for the first time in 7 quarters. And I think that's kind of interesting because, look at what we've been through the last 7 quarters. COVID, losing 3 points from a survey in December to 14 points from 17 points. That's really important because Japan is a big economy. The war is the single biggest factor weighing in on the markets. And I'm going to tell you guys, inflation, deflation, supply chain. It's all really great, but this is what's really driving this market right now, the war. The war and the fact that the market's holding up so well in light of the war is what's causing me to be so bullish. I wasn't nearly as bullish as I am in seeing what has been going on. Rising COVID cases in China are adding to worries of a regional slowdown. Not good. The lockdown in Shanghai entered its second phase while restrictions were lifted in hard-hit Jilin. Oil prices fell as Joe Biden ordered a release of 1 million barrels of oil per day for the National Strategic Petroleum Reserve. Folks, the world uses 97 million barrels of oil a day. He released a million barrels. 97 million barrels a day is the global consumption of crude oil. Do you think this 1 million is going to make any difference? Think about that. Think about that right now. Your net worth is $97 and somebody gives you 97 cents. Is that going to make a difference in your life? You're going to laugh at that person. 1 million barrels per day. That's all he's releasing. So I'm not really looking for oil to go down based on this. The war is the biggest single factor driving the energy markets right now. So again, the move to pump more oil in the market is part of an effort to control energy prices, which are up over 40% this year, and they're still up. And again, as I say, keep in mind, 97 million barrels is the consumption in the world, and he's releasing 1 million. I don't know what to say to that. Russia's invasion of Ukraine has elevated concerns that tightened supply will only worsen, and that's what I've been saying after the war, persisting rising inflation that threatens businesses and consumers globally. But again, maybe the Fed will back off if the war has a real nasty damage to the supply chain. So far, we haven't seen too much evidence of it. But again, we've only been in this war for a month. We're going to feel the impact of it a year from now. Investors received lukewarm update on the job market on Thursday. More Americans applied for unemployment benefits last week, but the layoffs remain at historic lows. This is why I was saying the reports this week so far have been kind of in the middle of things. We'll get a fuller picture today when we get the employment data. That's the report that's coming out right here that I've been talking about. Now, looking at the S&P 500, the big question for everybody right now is this market going to come back down all the way, or is it going to build a base? I believe that this market is done going down. I think we're going to build a base. I think we may come down a little bit, maybe to the 50-day moving average, maybe a little bit lower, and then start going back up. It would be foolish to think that after a rally that took the S&P all the way from here to here, from 410 to 460, that's 50 points, that's 10% in the S&P in less than 2 weeks, is going to continue without some sort of a pullback. The question is how much of a pullback we're going to get. We've been going down now for 2 days already, and the market still feels pretty stable. More so, SMH, the semiconductor index, has been cooling off a little bit, but it's still within this range. And the sector that I've been paying attention to, the consumer discretionary sector, is, again, we took out this level right here, and now I believe we're in play. So I believe the downside pressure is going to be minimal. I think we're going to be building a base around here, maybe not so high up, maybe around here, maybe somewhere in the following region, right here, building a base, consolidating, and then going higher. So if we start moving lower, the odds are we're going to go down for another bite of the apple to the downside, but I believe we're going to consolidate and build a base and start moving higher. But that's one of the reasons. So if you're in my programs and you're wondering why I've been so slow to put on positions, I've been slow to put on positions because the market is really overextended to the upside over the short term, and I don't want us to be I don't want to be bitten by it. So right now we have a couple of shorts, and I want to see how they're going to ride out, but I got to be very, very cautious right now because, again, the markets right now are not as stable as I'd like to see, but I like what I am seeing. Now, energies, utilities, basic materials, consumer staples, these are the most defensive sectors, and that's what's roiling this market right now, and that's what I would be in right now. Consumer discretionary technology, they're coming higher, and they're almost in play, and I like what I'm seeing, but till I see a further recovery till I see more upside, I would stay with energy, utilities, basic material, and consumer staples. You can't go really wrong with industrial either. I mean, industrial and basic material are on par. But the bottom line is stick with defensive sectors. Now, this week we took a nice little bite out of Apple. We got out right here. We were in this trade for 42 days. We got into this trade February 16th. Let me show you when we got into this trade. We got into this trade right here. We drove this trade all the way. The position was down against us at one point, I think 70%. And we got out right here with a nice juicy 20% profit, I believe, something in that ballpark. And then the market started cooling off. Again, I like where Apple is. And I think Apple and Microsoft are key drivers, and they're already near all-time highs. And I believe the fact that we passed through this level right here is very, 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 very important. So I think we're going to cool off just a little bit, especially after going from 150 to 174 and then regain this rally. So in the short term, I'm neutral, but in the long term, I'm becoming more and more bullish. And again, we haven't been taking too many profits off the table because the market has just been going crazy. But we had a nice little 20.25% profit, 42 days in the trade. So it's not unusual. Usually we stay anywhere from, I think our average right now is 18 days. So 42 days is quite a bit, but our average return in our discretionary programs, including the loser, has been over 7.7% per trade net profit since October. So I'm pretty happy with what's been going on, and my win rate has been about 77 point something percent. So let me tell you what I've got in store for you today, and you better pay attention. The markets have been up and down this year, to say the least, right? Whew, my neck hurts. Every day is like a roller coaster, and it can either demolish an account or it can be the greatest edge a trader could possibly have. Former $700 million hedge fund manager Jeff Zananeri would argue these are the best conditions for trading his overnight heaters. I love these heaters. He gets in at the last hour of the day. He gets out in the morning. No day trading, holding overnight, no emotions because the markets are closed overnight, so you can't really do much. So you get in right before the close, you get out in the open. 20 trades per month. He trades Monday through Thursday. This is hot. Very, very hot. Learn how he picks his trades. Learn how he trades these setups. Follow the link below now. And if you're watching on YouTube, go to the Wealth Press YouTube channel. Like us. Make sure you like us. Post some comments in the feedback. And you could follow the link there if you can't find this video. So it's in the description of the YouTube Wealth Press channel. Or if you're watching on the Wealth Press website, just follow the link below this video. Send me some love letters over the weekend. I want to hear from you. I get bored if I don't hear from you. And lonely too. Support@marketgeeks.com. Have a great weekend, guys. I'll catch you on the other side. Bye.